Thank you to BMO ETFs for sponsoring today's video. Dad, today we're diving into a topic that has gained a ton of popularity recently. It's covered call ETFs. And I was personally thinking this is a great one for us to tag team, given our dynamic, younger guy, older guy.
Careful.
Because, what?
Careful.
Yeah. Because this is something that I think, certainly it can suit both types of investors, but for very different reasons. So why don't we start the discussion off today with answering the question high level, what is a covered call?
Great question. And yes, this has become, the covered call ETFs have become very, very popular. So just some of the basics to start with. First off, I guess the main thing that you need to know when you're looking at what a covered call ETF is, or what a covered call is it basically combines the ownership of a stock with options. And so, for example, what you do is if you write a covered call, that's the term that they use, basically you're selling it. So you sell the option to another investor, and with that, they have the right then to purchase that stock from you at a predetermined price for a predetermined period of time. So, for example, you could sell them the right, let me backtrack, you own a stock trading at $50 a share. You say, at any time in the next month, you can buy this from me at $55 a share. Then if the price of that stock goes up, let's say to 57, well, they're going to buy from you.
They'll want to do that.
The price is 57, they're going to want to do that. So that is I guess one of the things you have to be aware of when you're doing that. So you're getting something today. You're getting a premium. They pay you a premium. They pay you a price that you can put into your portfolio. It just comes into your portfolio as cash. So for that, there's a trade-off. The trade-off is that if the stock sort of stays in that same range over those 30 days as the example, you just keep that premium. Doesn't matter what happens out there. You keep that premium. And then if, let's say 30 days out, the stock is trading at $53, well, they're not going to buy it from you for 55, right? They can go onto the market.
They don't have to exercise the option. That's right.
So that just expires worthless at that point. Then you move on to the next month period, or there's all kinds of different time frames that you can use to lock that in. So that's kind of the concept.
For sure.
How it works. One other thing to add here is when you own those, you can create cash flow from two different sources. Number one, if you own a stock that pays you a distribution or pays you a dividend rather, well, you get that. So you still own the stock.
Right.
Also, you collect that premium from the person. So that's kind of important to know that the fact that you've sold that right to the stock at a certain price doesn't mean that you actually lose the dividend on it. And for a lot of investors, you like collecting those dividends in the portfolio. So that's important to note there as well.
That makes so much sense. Yeah, thank you, Dad, for outlining that high level. Now, I think a lot of what you explained there was pertaining to like an individual stock. So let's say an investor is writing a call on an individual position they own. You did reference their ETFs. Now, how does a covered call ETF work? Is there a big difference? What do the people need to know?
Well, the structure, the mechanics of how an ETF or a covered call works are the same. But the difference, I guess, with an ETF provider, well, a few things come to mind. First of all, you have a team of professionals who are running it for you. You're not having to make the day-to-day decisions. They essentially are doing that on your behalf. That's one of the benefits. As a matter of fact, BMO...
Major benefit.
BMO was the first ETF provider in Canada to provide covered call ETFs. So when you are relying on those professionals, you don't have to make decisions on, which stocks do you buy, which premiums do you buy, what prices, all those types of things. So that's really important. As far as the distributions are concerned, essentially the same, only in this case, the premiums would be paid into the fund on behalf of all the unit holders, of course. And then in a lot of cases, those come out on a monthly basis. So you get a distribution on a monthly basis. There are some that provide quarterly distributions, but for the most part, they come out on a regular basis. Another benefit, I don't think I touched on this when I talked about the structure in general. I may have, but just the ETF itself, there may be a reduction in the volatility of the portfolio or the downside. And you got to be really careful with this one, Brandon, because a lot of people think that when you buy it and they hear that it protects downside volatility, it doesn't mean that there isn't downside volatility. You still own that stock. So, company X, you still own it. If it goes down, then the value of the ETF will suffer from that as well. But the cash that you collect from the actual premium that you receive, that will mitigate on the downside. So that's an important thing. I guess another thing comes to mind is just the structure of the funds, and this would be the same individual or with an ETF provider, is just the different market conditions, right? Always. Generally speaking, the more volatile the market, the more you can profit off of the option strategies. So that's in choppy markets. That's instead of you having to make those decisions again, they do that for you. So it lifts a lot of weight off your shoulders.
A lot of weight, Dad. So just to chime in, and actually there's a section I want to talk about today about, just in general, like the downsides or things to consider, because I think when people think of options, the options in and of itself is a very, very wide, broad category, and you can get down some pretty big rabbit holes, but these in general would be considered when writing a covered call in general, more or less a conservative cash flow generating strategy. For sure. And I think that's just something to be made clear. And on top of that, I just think about the value or benefit, for the average person out there, or even someone who is interested in having that professional doing the heavy lifting for you. Mm-hmm. Even if you know how to do it or care to do it, it's quite a task to be writing those on your own portfolio, especially as the portfolio grows and whatnot.
A couple of things come to mind as you say that, Brandon. Number one is, when you hear options, it falls under the derivatives category, and it sounds really, really confusing, and it very well can be. In fact, I'll just sort of make a confession here. When I was, in the industry, and of all the training I did over the years, by far the most difficult courses, I guess, or education I suffered through was the derivatives and options training. And wow, it was really confusing. It was kind of like I felt like I was juggling about 10 balls in the air all at the same time. so that's where the professionals, they're highly trained to do that. So that's a relief not to have to do that. And when I was managing money, I did for myself and for a certain number of clients, I did options trading as well. And it was definitely really tough. It's not something that you can set it and forget it. You're looking at that on a regular basis. So that's
so true.
To your point, it can be challenging.
Well, let's shift gears here to actually putting this into practice. When does it make sense to use covered call ETFs? And I'll say this, as a 30-year-old myself, among my group or camp of demographic, you do see the younger people benefiting and using covered calls as well. And I think a few very clear examples to me are investors that follow certain strategies or certain lifestyles. One that comes to mind is the FIRE movement. So the FIRE movement is the financial independence, retire early. It's not a catch-all, applicable to everyone, but a lot of people that are looking for this, retire early goal in life, they put a big priority on getting their cash flow up to where they can cover their costs and pay for their bills. So structuring their portfolio in such a way for, recurring cash flow is a huge priority. I see the covered calls being very, very popular amongst that demographic. Those who love the concept of a dividend snowball, where even if they're not necessarily drawing the cash flow, from their portfolio, pulling it out to go spend and, pay bills, even just, putting those back into the portfolio and getting that, so to speak, snowball going, that is a very, very trendy, popular strategy as well. That said, I know these are popular amongst the retirees, and maybe that's something you've seen or can speak on. I would come to think that this is where a product or solution like this really can serve its purpose.
Well, and to your point, a lot of retirees, or that's a very common use when you get a little bit up in age. You need that steady cash flow stream that coming in with these covered call products. You get it from the dividends and the option premiums. A big use that I've seen is for people who retire, and let's say you don't have a company pension, or maybe you do, but it's a few years out, or you choose not to collect CPP immediately when you turn 60, you want to defer that. It leaves you maybe a little bit short on cash, but there's going to be a longer term benefit by doing that to you. Or old age security, as an example, you can supplement your cash flow in that interim, right? So I would say between 60 and 65, you can generate that higher cash flow by using this type of a product here. Another popular use is just because of the regular flow that you have coming in, you can align that with your monthly expenses. So hopefully when you're retired, you know what your costs are going to be. And this is something you can depend on, you can rely on to provide you with the steady flow of cash. So that's another reason that people use it there. It is important to note, as I said before, that when you compare it to owning just the actual stock itself, sounds kind of the same because a lot of those stocks pay the dividends out, but they are different. You are capped with the upside if you're owning that covered call ETF. I did mention that just a few minutes ago as well. So that's something that's important to keep in mind.
Let's hone in on that, because that's something we always like to do on this channel is, talk about the downsides, if you will, or things to be fair and considered. And I think you nailed it there. I guess one of the trade-offs that you take on when utilizing a covered call or covered call ETF is you're essentially foregoing the upside, the opportunity cost, if you will, that your shares may get called away if, for example, the stock or the underlying does very well.
And I would say you're foregoing some of the upside. You still will have, in most cases, you'll have a few dollars, unless you're writing calls right at the money, but you're going to have a few dollars that you can go up. But if it goes past that strike price that we talked about earlier, then you forego anything past that predetermined price that you've indicated or that you've locked in at the time that you made the sale.
That's so true. It does. And I guess it also depends, like you mentioned earlier, there's so many factors like how the market environment is, what type of market we're in, and they can be more beneficial. Less ideal, certainly in something like, typically a bull market, right? If the bull market, stocks are going up, that is when, for example, you may, sorry.
I totally agree with you. In a bull market like we're in now, that's probably definitely the bull market will generally outperform a covered call strategy in this type of a market.
Right. But flat markets, choppy markets, this is where these products do come to shine.
I think the ideal is probably just a flat market, because you're not going to have those the securities called away from you. You're going to be collecting that premium on a regular basis, so that's nice. And then, of course, again, we sort of said on the downside, you do have that mitigation as well because of the premium that you're pulling in. So that's kind of I totally agree that it's not the most optimal strategy in all market conditions, right? That's really important to know.
So true. Well, let's finish off this video today, Dad. I want to go through a few examples of covered call ETFs, and what better option than going, showcasing a few of BMO's options, given they are the largest provider of covered call ETFs in Canada. If we can share a screen for a brief moment, we'll highlight just a couple, just to give you guys an idea of what is possible, what's out there. If we look at ticker ZWB, which is the BMO Covered Call Canadian Banks ETF. The name kind of implies it in and of itself. What this fund does is it's essentially giving you exposure to the underlying Canadian banks with a covered call strategy overlaid. One of the unique aspects of this fund in particular, as you dive under the hood, which, by the way, will be linked down below, of course, for you guys to do your own research and due diligence, is that it is an equal weighted portfolio, giving you exposure to the major Canadian banks with, of course, the covered call overlay. Another one to point out and maybe highlight is a ticker ZWU. The BMO Covered Call Utilities ETF. As the name implies, this is getting you a focus or exposure to utilities, energies, communication services within Canada and the US, with the goal of providing exposure to key holdings like Enbridge, TC Energy, Kinder Morgan, Fortis at the time of filming today, again, with the opportunity to generate additional cash flow from those covered calls. Maybe we'll dive into one more catch-all just as to wrap it up, but ticker ZWG, which is the BMO Global High Dividend Covered Call ETF. Now, this invests in a diversified portfolio of high dividend global companies, so all over the world. Here you're getting, the heavier US exposure at the time of filming, about 76%, with exposure to places like Europe, Canada, Japan, Australia. Case in point here is that there are so many different types of funds that you could go out and research and identify whether it suits your goals or objectives as an investor. All it takes is, from a base level, is understanding first and foremost, how covered calls work, like we talked about today, the benefits, the downsides, the risks, and if it does sound suitable for you, going in and for example, visiting BMO's website and viewing the various number of solutions that they have to find one that may suit your goals as an investor. And of course, as mentioned, we will include links below to everything we covered in today's video, some additional resources for you guys to go do your own research and due diligence.
I like that sort of summary you've done there, Brandon. And I hope that the goal of this video would be to just clarify what this really popular type of investment is, these covered call ETFs, because there is a ton of discussion about them these days, and a lot of people nail it. Some people have misunderstandings about them, and you're going to get all kinds of opinions. So hopefully this will provide you with some ammunition you need as you're doing your due diligence and going out and making the selections that are most appropriate for you.
Well, thank you for explaining, Dad, and sharing your knowledge. But if you guys enjoyed the video, give it a thumbs up. Leave a comment down below to let us know what you think. And as always, we thank you guys for watching. We hope you enjoyed, and we'll see you in the next video.